All right, we're doing problem number 4 from section 2 of chapter 15, and it's asking us what is the federal funds rate? That was an awfully drawn R. Federal funds rate. And what role does it play in monetary policy? So the federal funds rate is basically the rate at which banks borrow from one another. As you probably know by this point, part of banks' operations are borrowing and lending. So they lend their money out to whoever makes a withdrawal, and they borrow from whoever makes a deposit. But other people that they borrow from are other banks, just as a way to get other funds that they use for their day-to-day bank doings. But notably, as you can see by the first F, the federal funds rate, it is determined by the Fed, the Federal Reserve. And because of that, the Federal Reserve, the Fed, uses the federal funds rate as a way to stimulate or contract growth in part of playing a role as part of monetary policy. So if they want the economy to grow, say you're in a recession, they're going to set the federal funds rate very, very low so that it's comparatively less expensive to borrow. And if they want to contract, they're going to set it higher, so it's comparatively more expensive to borrow. And because of that, it's one of the Fed's most effective tools in doing monetary policy.